Welcome to the Scientific Sense podcast, where we explore emerging ideas from science, policy, economics, and technology. My name is Gil Eapen. We talk with world's leading academics and experts about their recent research or general areas of topical interest. Scientific Sense is an unstructured conversation with no agenda or preparation. We cover a wide variety of domains where new discoveries are made and new technologies are developed on a daily basis. We are most interested in how new ideas affect society and help educate the world how to pursue a rewarding and enjoyable life rooted in science, logic, and information. We seek knowledge without boundaries or constraints and provide unedited content of conversations with researchers and leaders who love what they do. A companion blog to this podcast can be found at scientificsense.com, and this podcast is available on over a dozen platforms and directly at scientificsense.net. If you have suggestions for topics, guests, and other ideas, please send them to info@scientificsense.com, and I can be reached at gil@eapen.info. My guest today is Professor Sudheer Chava, who is a professor of finance at Scheller College of Business at Georgia Institute of Technology and leads the Financial Services Innovation Lab there. Sudheer's research interests are in credit risk, banking, FinTech, household finance, empirical asset pricing, and corporate finance. Welcome, Sudheer.
Thank you, Gil. I'm very happy to be on your call.
Yeah, thanks for spending the time. I want to start with one of your papers, investor response to extreme language in earnings conference calls, in which you say you developed a dictionary of linguistic extremity in earnings conference calls, and setting where managers have considerable latitude in the language they use in the earnings call as well as in financial reports. To study the role of extreme language in corporate reporting, you say controlling for tone, positive or negative, of language. You document that when managers use more extreme words in earnings conference calls, trading volume around the call increases and stock prices react more strongly. It makes intuitive sense there, but it's also sort of puzzling in some ways. So you want to talk a bit about that?
Yeah, sure. Happy to. First, this paper is co-authored with my colleagues, Christina Bochke. She's at University of Miami, and Jeffrey Hales, who's at Georgia Tech and now at University of Texas, Austin. And this project started for us thinking about language in a way, in terms of when we think about the SEC documents, when firms file their text documents with SEC on EDGAR, whether they're 10Ks or 8Ks.
Yeah.
Sometimes they're boilerplate because they go through many iterations, and what they can actually mention, those are a bit limited because it's a legal review happens, right. And they are much more deliberate on that. In contrast, when we look at earnings conference calls where the senior management is talking to analysts, they're a bit more unscripted. Because there's a question and answer session, and some of the information might come in, which I think comes out of the interaction. So that's what we wanted to look at first.
Yeah, so it's interesting. There was some explanation why stocks react to reports, financial reports, or even earnings calls in a regime of sort of efficient markets. That information should be already in prices. But one explanation is sort of the signaling effect in there, right? So if the company misses, given that the company has a lot of accounting flexibility, I guess investors are saying they could have made the number, but they chose not to. Perhaps they're trying to tell us something. And there is also a signaling effect here in terms of language use.
Yes, when you think about it, as I said, this is a bit unscripted. So somebody might say, like the firm has controlling for the same kind of quantitative information. Let's say the earnings per share or profitability of the firm. A manager might say, like they had a good performance, or somebody might say they have spectacular performance.
Right.
So the idea is again to see if there's a difference between if there's any kind of information that comes out, there's any signaling based on whether they said there's a spectacular performance versus whether there's a good performance. That is, the two firms might have the same $1 in EPS, or they might have the same type of profitability. All the controlling for the quantitative information as best as we can, either more information in the language. And that's what we find in a way.
Yeah.
That is basically, this is a predictive of the future. So one can argue that why this information not priced immediately, or why would there be like market price this one? As you said, there's a signaling thing. But as more and more firms maybe incorporate this kind of textual analysis, or I think in terms of parsing the voice and the tone of the managers, what language they use, probably in the future the markets will be more efficient. And again, this will get incorporated much more quickly.
Yeah. So did you do any sort of longitudinal studies, Sudhir? So obviously language is person dependent. Some people tend to use extreme language for everything, and some people are less so. And so
probably Tesla is an example. Yeah.
Yeah. So have you looked at, so like one CFO over time, how he or she approached it and how the markets might have reacted?
So in this case, in this particular case, we haven't, but it's a very good point. And I think it is possible. Definitely there will be styles. I think other research has looked at it, and there would be styles where the CEOs or CFOs might have style, and that's how they talk about it. Right. So that definitely is a possibility. So in this case, what we wanted to do was first, I think, because we had to pull in a large number of earnings conference calls and then parse them. And then we had to actually develop a dictionary. What is extreme? So we went to Mechanical Turk based on all these words. Then we had a number of users score them. And then based on that, we were able to classify them from a -5 to +5 of extremity. So our part of our contribution is coming out with this dictionary of extreme words, which is a bit different from just positive and negative. Yeah, this one I think is controlling. Both might be positive. As I said, earnings might be good, great, or spectacular. Right. So I think, and I think that's the contribution. So we haven't controlled for the style of the manager per se. Yeah. But definitely, I think for the firm, as long as the manager hasn't changed, we have control for some of the firm specific things over time.
Mm-hmm. Yeah, so firm-specific things, meaning industry size and things like that?
Yes, a large number of control variables which have to do with the quantitative information that comes out along with the earnings. Because one of the concern might be, is the market reacting to the information which is there, the extreme language, are the market reacting to some quantitative information which is there? Right. So we want to control for number of earnings-related measures which come out around this time. And also the firm-related characteristics, and also the industry characteristics. After controlling for all of them, we look at whether this extreme language has an impact. And then we also do a lot of cross-sectional analysis. Again, as you expected, some of what you mentioned before, if the firm has, again, it's a large firm, or if the firm has a large number of analysts, I think you can think about how they might have a different role to play. So if the firm has a weaker information environment where there's not as many analysts following the company, so there might be more information coming out through the call. So that's what we find.
Yeah, so it's really interesting. There is also sort of, perhaps in the future, you might be looking at style and how many people spoke at the conference calls, maybe the sequencing of those calls and all of that. So the whole choreography that a company goes through.
Yeah, I think we have done, that's a very good point. I think we have done some of it, but I think some of it has been done by other researchers. That's why we haven't explored that angle as much. But we did break it down into whether it's done at the level of introduction, whether it's part of Q&A. And because we can break it up into whether there's a question and answer session, we can basically say who asked the question. And I think what was the answer? And then we can look at those parts of it. You're right. There's a lot of work to be done. And in fact, actually, like with my PhD student, I'm actually working on a couple of other projects on this one related to this one. And one of them is actually about looking at the earnings conference calls, but also looking at sustainability related measures of that. So there might be a lot of talk about environmentally, social governance related features. And it's right now in vogue. And many people will be talking about they're actually implementing a number of improvements or number of initiatives around these issues: ESG, but it's impact investing, environmental issues, social issues, governance issues. So what we wanted to do was look at these and over a period of time and see like whether these have gone up in the earnings conference calls. By the way, it's a work in progress, so we are still working on it. But since you mentioned it, I thought it would be interesting to look at it. But also, like the second part which we are working on is to see, is it just the talk or the walking the walk? That are they really implementing these policies? I don't have the answers yet for that. We're still working on it. But there are many interesting things to be done. This is still relatively new data because of the improvements in text, voice. We can actually look at these. So I'm pretty interested in it. And we are going to work on a number of other projects.
Yeah, very interesting. I want to jump into another paper entitled "Does History Repeat Itself? Business Cycle and Industry Returns," in which you say industries with higher historical business cycle regime Sharpe ratios, RSR, have higher regime-dependent expected returns, and condition on whether output gap is positive or negative, and out of sample, long high RSR and short low RSR sector rotation strategy generates about 14% annualized alpha in the Farmer-French 5-factor model during 2014. 14% alpha is big. And so how do you define a regime Sharpe ratio?
So, okay, just as a background for this project, this I think has been going on. This is with my former PhD student, Ling Hang, and I think one of my colleague, Alex. And I have to give my co-author, I think Ling Hang, a lot of credit. Again, the reason why for a long time I was always thinking about the sector rotation strategies and how to actually improve them. Again, as you know, like there's a number of funds which actually implement sector rotation strategies. And some of them do well, some of them don't do as well. And my view was, if you can actually predict the next step of the business cycle in a way, it might be, you might be able to get some alpha out of that because you are ahead of the game before even the sector rotation happens. And you can see it happening. That I think in bad times, there might be more of utilities and more of defensive stocks. In good time, I think there might be more growth firms. But partly it didn't work. I think when I tried it initially, it didn't work as well. That's when my co-author Ling Hang, my former PhD student, I think came out with this Sharpe ratio. And I think which actually was, I think, pretty good. It worked out in a way because now we are not only looking at in terms of the return, but we're also adjusting for, in a way, the standard deviation of this one. So that way, I think we are able to actually get a more this information in both these movements. So basically, one can get a better proxy of trying to predict the future. There's actually two angles to this paper. One of them is coming out with this measure of this historical business cycle Sharpe ratio. And other thing is, what can you use to actually predict the business cycle? That's where we go and construct this output gap measure. So that output gap, I think the idea is when output gap is positive, then again it might be that business cycle. I think the economy might do well because there's more of slack in that. I think in a way, there's still more to be done in the future. So the combination, I think, is what got us.
Okay, so what do you mean by the business cycle regime Sharpe ratio? Is that a Sharpe ratio in a specific window? Is that what you mean?
Yeah, typically we look at over the last 10 years. We haven't been, it's not a very short-term thing.
Yeah.
We look because we want to cut down on the amount of churn and the amount of trading that would be done.
Yeah.
So we have looked at the past decades. I think we have that tried at different time periods, but mostly over the last 10 years. And again, it's more, you can see that some of the industries that rank there, I think are pretty reasonable. I think in a way, you would have utilities, you would have some kind of beer, and you would have other kind of industries, which would do even well in a consumer, which consumers would always buy this stuff, right?
Okay.
I think versus consumer discretionary, there might be more cycles out of that.
Yeah. So for my own understanding, Sudhir, so there are two things you say here. One is the Sharpe ratio based on sort of the business cycle Sharpe ratio, which would imply that you're going to compute this in a specific business cycle window. And then you say that the strategy itself, the long high RSR and the short low RSR, that is conditional on whether the output gap is positive or negative. So how you would decide which ones to long and which ones to short depends on where you sit on that business cycle point in terms of time.
Yes.
Okay.
Yeah. So what we do is for each, we have the sector rotation strategy. We normally, we need a long time period because the business cycles, as you know, one of the issues is you can't really use a short windows. Yeah. Because the business cycle, I think we need long enough data. Yeah. So what we do is we look at the beginning of each year, why, like for example, if it's let's say in 1985 or 1995, the regime for that year we based on the sign of the output gap in November of the previous year. So let's say we take 95, we're looking at what the sign of the output gap in 94 is. And then I think then we sort the industries based on the Sharpe ratio from the past few years. Okay. So it goes back, we actually go back all the way to 1928 because we need a long enough time period, but we do a rolling basis also so that I think it's not as much of an issue.
Yeah. And so are you always long on high RSR and always short on low RSR?
So typically we long industries, again, the industries which, yes, we do that, but the industries which are in that highest decile change. So we typically go long on the industries in the highest decile and short industries in the lowest decile.
Okay. So this is not, okay, so it's sort of industry rotation, but it's more buying the winners and shorting the losers a little bit.
Yes, there's definitely an industry component to it. And that's why I think we make sure that the standard industry momentum is not, I think this is not explained by that. We control for all that. Okay. And after that, we get this alpha, I think around ranging from 8% to around 14%. But going back to your previous point, again, why such a high alpha? Yeah. And would it last in the future? I don't know. Again, the researchers, I think there's some research, I think, done by a faculty from other universities, which showed that once the academic study has been published, then some of the predictability goes down.
Right.
One can take it as a couple of reasons. One, maybe this information that comes out through this study. That's why I think other industry, they start implementing that. Yeah. And if enough number of investors trade on this strategy, the alpha should come down. Right. That's one. Or it might be that maybe there's something about this particular strategy and the particular time period it works, but maybe it's not as robust out of sample.
Right. Yeah. I know that, your students, a lot of your students want to go to Wall Street and make $1 billion tomorrow. But typically it's not that easy, right?
Yeah, it's definitely not easy. And that's what I tell them. I think in a way, it's not simple. You can't sit at your desk or on a kitchen table and program a machine learning algorithm and then go and make the alpha because you are trading with the big boys. In a way, you not only need to have a very good model, but you also need to have access to data. Right. In many a time, I think my students, they think of it as, which I think they're very smart students, but part of the learning is it's not just enough having a very good model or a complicated model, right, where it's a machine learning model or AI model to make alpha in the markets. Right. One has to combine with some very good data. It might be alternate data, or it might be some other proprietary data.
Yeah.
But again, as you know, if enough people trade on this data,
Right.
again, the information gets incorporated to the prices. You might not find as much of alpha going forward.
Right.
So sometimes a simpler model with a better data or data which others don't have, which has predictive power,
Yeah.
could get a better alpha.
Right. Right. Yeah, I always say that the financial markets is a great ego leveler. Because
It keeps us on the toes. Yeah.
yeah, in real markets, if economy is generally moving up, even incompetent managers could look pretty good.
Yeah.
But that is not possible in the long run in financial markets. Your incompetence will be shown very quickly.
You're very much right. I tell the students that's why I think, in a way, if I had known the magic ball, I think then I would have been making a lot more money. But I think probably finance faculty are not the ones you should ask for investment advice, because we take academic view, a long-term view,
Right.
and I think into account. But you are definitely right. Yeah.
Yeah, so I want to go into a corporate finance paper. So it is entitled Pension Overhang and Corporate Investment, in which you look at an exogenous universal increase in discount rates mandated by the Moving Ahead for Progress Act, MAP 21. I don't know anything about this act, but it looks like that basically reduced sort of the pension liabilities that the companies are carrying in their balance sheets. And then you're looking at what that change might have done to their investment posture. So what exactly is MAP 21?
So this again, this paper is with, again, many of my work, I think, is with my PhD students. And I think this paper is with Peter Simasek. I think, and again, I have to give him a lot of credit for this paper. And then another former student of mine, Emmanuel Alanes.
Yeah.
And Peter used to work at PIMCO and I think, and also at Bank of America. And he had a lot of experience with the pensions. So he basically came to me, I think, with this broad MAP 21, and that's how we started this project. But MAP 21 was passed in 2012, and this was actually set up as part of the transportation bill at that point of time. So the broad idea is by increasing, in a way, the discount rate, in a way, the liabilities would become smaller. So what, I think the idea at that point of time was to reduce some of the tax benefits to firms out of this pension contribution that they're making. So that's why I think it was put as part of it. So by putting the discount rates, change the discount rates, there's going to be less of tax deductible firm contributions. So on the transportation bills, there's some, it's used as an offsetting revenue component. So that's how it came in. That's why it's a nice exogenous thing, because it's not meant to be directly to influence the pensions per se, but it was meant as a more of a revenue offsetting bill. So that's why I think,
So when you say the discount rate reduction, so there is no change in the pension liabilities looking forward, but what they carry in the balance sheet as liabilities change because they're using a different discount rate. Is that?
Yes.
Okay.
It's almost by 200 basis points. So it was increased by this particular point discount rate was increased by almost 200 basis points.
Okay.
So what we wanted to do was take that, and I think as the shock, in a corporate finance setting, many times we are worried about the exogeneity, we are worried about identification. Is there something, I think, when we identify some result, is it because of the channel that we have in mind, or is it because something else happening? Is some omitted variable which we are not controlling for regressions? When we talked about the analyst paper, the extreme tone, you mentioned what else we control for. But there's only a set number of things that we can control for. But there still might be something which is omitted, which we're not controlling for, which might be driving the results. Or there might be something else happening at the same time, which might be contributing to the result. So we are try to be as careful as we can, and we can't 100% be certain. That's how I think of it. We try to do a number of things to give more confidence that what we attribute to the channel is what is driving the result, but we can never ever 100% completely rule out. That's how I see it.
So, this is an accounting change. There is no cash flow effect, right?
Yeah, that's what we find. I think in a way the cash flow effect is not that strong, but we find it's more of the accounting effect.
Yeah.
And based on that, I think we can compute a measure. In a way, we compute what we call a pension overhang measure.
Yeah.
And using that, we can look at whether what happens to the firm's investment and firm's other corporate policies.
Okay, so very simplistically, the firm feels like it has more resources to invest but there is no real cash flow effect. It's a bit like people going out and buying houses when the stock market goes up, even though it's all tied up in stocks or options. But you find that after the accounting change, firms have increased their investment, right?
Yes, I think firms have increased by almost, depends on the size of the firm, depends on where they're doing. But we find a one standard deviation change in our debt overhang correction measure, the 6.6% change in investment. So if the firms have a above median of measure based on this dimension, after MAP 21, the investment is almost 13%.
And there is a difference. You also looked at sort of the C-level execs pay. If it is more tied to performance, there is a difference there as opposed to more conventional pay schemes, right?
Yes, I think we can look at, based on the CO compensation, we can basically look at that. And I think there's definitely a relationship based on that. And it makes sense. It's not, again, there's nothing wrong with that.
Yeah.
It's basically because from a stockholder point of view, like you want firms to make positive NPV investments. Yeah. And that's part of the reason why you give the incentives that you give to the managers.
Okay. So more generally, Sudheer, would you say, I didn't read the whole paper. I'm just looking at the abstract. Would you say this idea, I mean, this is, a lot of firms are suffering from it, right? They have pension plans that have very high liabilities in them. And that is kind of filtering into their investment posture. So would you say any change in that arena would ultimately result in a higher level of investments by firms?
Yes, I think as again, not only like the pensions, I think are an important part, I think for the company liabilities in a way, because ultimately it's debt, whether directly recognized or not, it's one type of debt. So anything that changes that obligation, again, we can think of GM, I think in 2008, or I think other auto companies, or some of the companies have legacy pension plans, which are pretty like large in terms of their liabilities. So anything that changes the value or had the potential to change that would have some impact on the investment policy of the firm. So that's the bottom line. That's what we're finding. And this is something which I think not only for companies, but also I think for municipalities or I think for local governments, I think of it as a big issue going forward. Because there's, again, looking at the demographics, looking at the state of local government finances, I think that can be a big issue going forward.
So I haven't really, thought about it, but from a stimulus perspective, from, economic stimulus perspective, there could be some policy possibilities here. If there is a way to reduce you're almost reducing, I think, the perception of liability, because there's no cash flow change. It's almost how the firm internalizes its liabilities. That's what's being changed, right?
Right. Yeah.
So I wonder if there's, some kind of government policies that could be conceived.
Probably. I think the more fundamental issue, I think, is in terms of how companies have, what kind of pensions they give, what kind of pension liabilities they have, the structure of it. Can they actually bear those liabilities? Are they being properly accounted for, either in the company's balance sheet and the local government's balance sheet? Yeah. And if not, I think then it is going to definitely have an impact on their future investment policies. Okay. And if in terms of the government policies, that would be like, I think I don't have anything in mind where I think I can say the government should do this one. Yeah. But definitely, I think anything that changes the liability or the value of the liability is going to have an impact.
Right. right.
And especially for if the firms are constrained, because if the firm, the broad idea is sometimes from the cash flow effect, sometimes the firm might have to contribute to the pension, or they're thinking about investing. But now I think if the pension before it was underfunded, and now because of this law change, this no longer underfunded, then they don't need to contribute to the pension plan, so that they might be able to invest.
Right. Yeah, so I want to jump into another completely different area. So impact of e-commerce on employees at brick-and-mortar retailers, in which you say using an employer-employee payroll data set for approximately 2.6 million retail workers, you analyze the impact of staggered rollout of major e-commerce retailers' fulfillment centers on the income and employment of workers at geographically proximate brick-and-mortar retail stores. So from my own understanding, so the fulfillment center, at least I would have imagined the fulfillment center is sort of robotics-driven automated fulfillment process that's creating products that's going all around the world. The proximity of the fulfillment center having an impact on income and employment, I couldn't quite understand that. Could you go into that a bit more?
Sure. And this one, I think, is a broad theme, I think, which has been playing in my mind for some time. Again, before we talked about artificial intelligence and machine learning, I think, and again, the nature of jobs are changing in the US and also elsewhere. Technology has developed so much, and I think it's changing, I think, by the minute. If we think about on any dimension, I think in terms of what was possible 5-10 years back in terms of whether machine learning models, deep learning models, natural language processing, NLP, I think now IoT, I think there's so many things changing. So the nature of work is changing. The broad theme I had in mind wanted to see this whenever it changes, the nature of work changes. It's not that the skills that the workers have, again, it might be a blue-collar worker, white-collar worker. Again, as we see in the recent COVID-19 crisis, again, we are going to see this kind of thing going forward. But going back to this paper, it's going to change, and it's not that they can adapt to it very quickly. Some people, some jobs, they might be able to change, adapt, and then go and find a different job. But some people might not be able to do that for a variety of reasons. So what we wanted to do was take this fulfillment center, if you look at retail sector, that's one of the largest employers in the US. And so what we wanted to do was, over the last 10 years before the COVID, one of the biggest shocks in the retail space is, again, entry of e-commerce. The major e-commerce firms coming in, starting from Amazon to others. So what we wanted to see was how did it impact the workers, and again, is there an impact, and who's left behind in a way, the winners and losers. So what we find is once a fulfillment center is set up in a place, we look at within 25 miles to 50 miles to 100 miles of that area, we look at the traditional brick-and-mortar store employees. That is, let's say a fulfillment center is set up in Atlanta. We look at within 50 to 100 miles of this area, all the other traditional retail stores. So, and the workers of those stores. Since we have the payroll data and we know the number of hours they work, we can quantify in a way, because this happened in a staggered fashion across the US. So we can look at before and after and compare them to similar counties where there's no fulfillment center.
So a large e-commerce company coming into Atlanta and putting a fulfillment center, let's say in Atlanta, as a thought experiment, I would have imagined that fulfillment center is essentially creating, services and products that's going to be distributed all around the country, right? So why would that have an immediate impact on the retail stores in close proximity to the fulfillment center?
It's a good question. I think so. We struggle with that. I think, and our thought process is when a fulfillment center comes to Atlanta, in a way, the shipments, it's easier for them to actually ship quickly. They have more number of things they can ship on the same day or within 2 days.
Okay.
And what the fulfillment center, what they might be able to do is they might be do some kind of predictive shipping, where they know that this particular location, there might be a demand for certain products. So they might preemptively ship them to that location. And again, this is not just for the company per se, but also third party retailers. Which that means some firm in California might be able to reach out to a customer in Atlanta through this major e-commerce firm, which I can't name, and the fulfillment center.
Right.
So that's why the shipping speed goes up. That means more people, more consumers might be interested in purchasing them. Right now, the trade-off for them is I might be able to order online. It might take me 3 days or 1 week. Or I might be able to drive to my local store and I might actually get it in 1 hour. But now the trade-off becomes if I order it before certain time, I might get it by tomorrow. So it's going to be, and what we actually show that what we have is we actually have data on the sales and employment of a large number of stores. So in the surrounding areas, around 3.2 million stores. And then we actually show that the sales of the surrounding retail stores goes down. Because of that, the number of workers, the number of hours they work, part-time workers, now that goes down.
Yeah, that's so interesting, Sudheer. So, as you know, we don't have to name any names here. There was a big fight in New York recently. And, just like I was thinking initially, why would a fulfillment center destroy local employment was counterintuitive. But what you're finding is that because it changes the delivery dynamics in that corridor, it competes away any profits that might have existed in small stores around that fulfillment center.
That's right. And I think, again, I'm not saying it's only negative. Again, the way we think of it is there's trade-offs. So the fulfillment center by itself creates some jobs. So it's not a negative, but the number of jobs, I think, which are lost in the retail sector are more than the number of jobs created by the fulfillment center, the warehouses, and the transportation sector, in a way like delivery and others. Right. So that's what we find. But also, who does it impact? So in the sense, there might be a cashier, for example, the way to think about is a cashier at a traditional brick-and-mortar store, but at a warehouse or a fulfillment center, you don't need a cashier. That is the nature of jobs, and who gets left behind changes. Right. So some people who are left behind in the traditional brick-and-mortar store, they might be able to go to college, or they might be retool and go and find a different job. Right. But certain skills, I think, are not easily transferable, or people might not be able to easily shift. That's when I think it's going to be a problem. We just wanted to highlight the trade-offs, not necessarily say e-commerce is bad. I think it's irrevocable. I think it's a one-way street. I don't think it's going to change. All we want to say is if there's going to be any policy responses, or if we want to highlight the trade-offs, who might be winning, who might be losing in a way. Not losing, it might not be the right word, but in a way who are suffer more. So there might be more targeted responses for that. Because we think of it as a simple big trend that's going to happen. And the current COVID situation, again, as you know, is going to make it, it's moved, I think, the e-commerce into a different phase.
Right. Yeah, I mean, it makes the policy question really difficult, right? So one could argue, you have a market which is sort of operating inefficiently with small stores, and their fulfillment capacity in terms of time, as well as ultimate cost to consumers are probably higher than the alternative. So consumer welfare actually goes up when the fulfillment center enters that market, but unfortunately, it's going to bring with it loss of jobs, and like you say, there are going to be winners and losers. The consumers in aggregate are winners in the market because they get their product faster, cheaper, possibly. But then it's going to impact negatively the workers that exist there.
Yeah, you are spot on. I think in a way, consumers are definitely benefit a lot, and we can't quantify. We don't quantify in this paper, and we are very upfront about this.
Yeah.
There's a number of benefits of e-commerce. There's a number of benefits of these fulfillment centers, but all we want to point to consumers benefit from it from a number of dimensions. Maybe cheaper prices, maybe more choice and speedier delivery, less driving. But we can't quantify that. But all we want to say is the flip side of it, where the local small store which used to sell now is not only competing with the big e-commerce firm, but also all the other stores which might actually sell through this right now. So
there, I don't know if we have laws around it. So could you say, if you take that local market, and a fulfillment center coming in, it is basically extracting monopoly rents in that market. So it is extracting profits that, could you actually regulate in such a way that to say it is good because consumer welfare is going up, but the profits extracted by the e-commerce retailer has to be expended in that market in some way to counteract the loss of jobs.
That's one possibility. I think I'm always a bit careful about giving policy recommendations. I think because my role, I think as an academic, I think is to shed light on something.
Yeah.
So that I think there might be just to show the trade-offs. So policymakers can consider everything, because whenever something is set as a policy, there can always be a flip side to that.
Yes.
But that's definitely one point, because there's maybe some kind of funding some educational initiatives in that particular area. Might be one. I think, So, but e-commerce, I think, is not going to change. It just, what we want to shed is there's going to be a large number, I think, of workers who are going to be in trouble because of this. So how do we take care of them? How do we make them ready for the jobs which needed? We just want to point out this kind of trade-off here.
Yeah. And it's really, like you say, it's skills upgrade that would be needed. And so, I mean, like you say, this is, you can't pull away from it. This is a trend that has happened, that's going to continue to happen. The HR requirements in these processes are going to continue to decline with robotics and artificial intelligence. And so broadly, the issue is education and skills upgrade, and things like universal basic income and things like that. So there are a lot of issues around this that policymakers need to think about.
Yeah, there's a lot of interesting issues, and I think I'll mention a couple of other things that I'm doing. I think maybe because this theme, I think, is bigger in my mind. Is one is actually we don't necessarily think of it as increasing the minimum wage, I think, as an answer for this one. In another research, because another paper, what we look at is the minimum wage changes, and in various states, I think, based on the federal minimum wage change. So some of the states, as you know, in the US are bound by the federal minimum wage and some are not. So then some of the states have a higher one. So what happens when the federal minimum wage changes is the states which are bound by the federal minimum wage, now suddenly there's a shock for them in the sense that their minimum wage goes up. So what we wanted to see was, does this one size fits all serve is it a good thing?
Yeah.
In the sense that now what you're having is, for example, if you think about a small business, which is, let's say, in San Francisco, the minimum wage goes up. Maybe it's okay. In San Francisco, people might be willing to pay $5 or $10 for a latte. And maybe they can pass on some of the cost to the consumers.
Yeah.
And so the workers get a higher income, and the consumers are willing to pay for it. So the small business, even if it takes some small cut in its profitability, might be okay. But what about, let's say, another firm, a small business, maybe somewhere in the middle of Georgia, which is an area where it can't pass on the cost to the consumer. So then basically, the only way it can absorb this increased minimum wage cost is either it actually increases its automation, or fires employees or reduces it. And because if it can pass on to the customers, then it's okay. But if it can't pass on, then it has to take some action.
Right.
So, for example, it might be that I think if you increase the minimum wage a lot, maybe like a car wash, they might actually end up employing more of robotic car wash rather than employing more people.
Right,
So the
right.
kind of trade-off we wanted to look at, again, not necessarily saying minimum wage is good or bad.
Yeah.
We don't have we don't have anything to say on that because it's a extremely large, well-researched area. But
Yeah.
all we want to say is whether a one-size-fits-all minimum wage across the country, like let's say going to $15, or I think as people have been talking about,
Yeah.
we wanted to show that some areas where the small businesses can't pass on the cost, they'll be worse off.
I see. Yeah. So yeah, that's very interesting. And so you would then say that the job losses that some argue associated with increase in minimum wages is going to be differentially found in certain markets and not others. So from a policy perspective, there are certain places you could do that, but certain others you're going to have a negative effect on employment, as some economists predict.
That's right. I think that's why I think what we think it might be good is to cater this to the local market. One way you can think about it is completely, if you think of purely market-based view, then one can think of like maybe the small businesses and the labor, they can set the wages themselves. There's no need for minimum wage. But that assumes that, again, the labor has the power, and I think the market is perfectly competitive. It might not be. So there might be an intermediate thing where instead of setting at the federal level, maybe there's something where each state or each county or each at a local level, as appropriate, the minimum wages are, I think, based on the local conditions.
Right, right.
So then I think basically some of these issues might go away. That's all we want to point out in that. But not necessarily to say minimum wage is good or bad. We don't have anything to say on that.
Yeah, that's very interesting because almost all the literature, I mean, I haven't really researched this, obviously, is about this binary question: is raising minimum wages good or bad? Right?
Yeah.
And what you're suggesting is that question has to be answered based on the markets. At the very least, it has to be answered based on the states. At the very, very least. Assuming states have, some common characteristics, because I've seen some studies in the 90s where, people just go across the border from one state A to state B and say, yeah, this doesn't work. And hence I argue that, you shouldn't increase minimum wages.
Right.
And so you can pick your state where it works and where it doesn't work. That's what it looks like. Yeah.
Yeah, that's true. I think many of my research, I think that's why I think I try to just quantify some of these trade-offs. And then I think just to shed light on them, I think so that I think it's interesting. And another one, which is a bit related, I think, which you might be interested is in terms of, you mentioned about the New York, the recent subsidies, corporate subsidies.
Yeah.
In the US, there's around $38 billion of corporate subsidies given in the last 13 years, that local municipalities, local counties, local governments, they give these subsidies to attract companies, sometimes to retain the companies because they want to, it's jobs. I think in a way, like I think when a new company comes in to town, they bring jobs, and which is, I think, a very good thing. So local economic development corporations do that. But what we started thinking was, again, to quantify some of these trade-offs. In some cases, maybe it's a good thing. If you bring in, it's a positive investment by the county that it goes and gets this firm which might get in a huge number of jobs, which might actually improve the county or the particular state's economy. And there might be some ancillary benefits. Ancillary industries might come in. There might be some spillover effects. There might be jobs multiplier. One job in manufacturing might create two jobs in restaurants and some other related way based on the spending.
Yeah.
But at the same time, maybe like some cases, it might not be true. If the counties might overbid because there's a lot of competition. As you know, recently, for example, with Amazon, I think around 250 different local governments bid for that. So what's the right thing? So what we wanted to quantify was from a finance angle, look at that. And the way we could, but many a time it's a tough question to actually see what the real benefit, net benefit is. Because if you think about Foxconn and Wisconsin or some other cases, these are spread over a long period of time. It's not a 1 year thing to look at, okay, how many jobs are created the next 1 year. The investment plans are phased or 5 years, 10 years, and the subsidies are phased over a period of time, and the jobs also come in, and it's difficult to quantify how many jobs came in, what level of jobs, what's the salary level, etc. So what we take is a different level. We look at the state of the local municipalities. We look at the municipal bonds issued by these counties, local governments, and we look at what happened to the yield spreads of these existing municipal debt. That is, if the investors think this is a positive thing, there's going to be more growth, there's going to be more jobs coming in, it's good, then we should find a positive effect. In a way, the yield should go down. Whereas if the investors think that this is actually going to cause more costs than the benefits that come to the county, then they might actually vote to their feet in a way, and the yield spread should go up. It should become more costly for the local municipality to raise debt. That's exactly what we find.
That's a very easily measurable thing. It's very quantitative. It's very objective. So that makes a lot of sense. The other thing that you're showcasing here, I think, Sudheer, is that a job is not a commodity in the sense that we cannot say a firm entering a location is going to bring 100 jobs. The more important question is what type of jobs. And maybe the compensation is a proxy for the skill set. I don't know. But the quantitative measure of how many jobs are being brought into a location is increasingly irrelevant, right?
Yeah, it's not just the number of jobs, but also how many spillover jobs it might be able to create in other industries. That's one thing which, to some extent, I think they try to take into account when the local economic development corporations, but still I think it's not a perfect measurement. So that's part of the issue. And also in terms of what type of jobs, as you mentioned, if this, if you have a R&D facility and because of this one, other R&D facilities come around it, this area becomes more innovative, then it might be good. Or if it's just like for example, a data center, sometimes data center is good, but data center is like if you have like robots manning most of the time and you hire 5 employees and it's not creating any other ancillary things, then the value of that might be less. So it's a more nuanced thing where one has to take into account what industry, what type of facility, what type of jobs are being created, and how much net benefit there might be. So what we find is if the counties, and also one interesting thing which is also there is many a time companies bid for it's not that a county, maybe big cities bid for multiple facilities, multiple industries, but sometimes some of these counties are small. So the bargaining power when they are looking at big firms, $1 trillion companies, is a bit asymmetric. It's David and Goliath kind of thing where you have like this big companies which can use a number of consultants and who know they have a very good idea of what the point which they can ask for in a way. Because they have very good data and they have very good analytics and they can actually have a very good sense of the market. And negotiating with certain counties and which might not have as much of, they can't afford as much of expertise in a way. So what we find is when the counties have weaker bargaining power, in a way they give out more subsidy relative to what they're getting in a way. That's where the borrowing costs go up more.
And so that should show up in the yield spread as well, right? And so sort of, knowing that the entrant would presumably take advantage of it, right? Maybe the entrant wants to negotiate with a weaker negotiator. I wonder if there is any evidence for that.
I think many a time for the counties, I think what we actually look at is we look at the county which is won the deal versus the competing county which is almost close. And then we look at the winning county and then what happens on that, because we need a counterfactual. Again, the issue is the county's municipal debt, the yields went up because of this deal, or maybe it's in a trajectory because in a bad trajectory, that's why the yield spread would have gone up irrespective. to rule out, we look at the top two competitors in a way, and then we look at the second best, and then we look at the difference between them. But yeah, there might be like in terms of many large companies, they would be at any point of time, they would have a division, they would have a number of employees who are just focused on finding out the right sites, right facility.
Right.
So their expertise is a bit definitely lopsided.
Yes. Yeah, I want to touch on one more paper, Sudhir, before we close.
Sure.
Revealed heuristics, evidence from investment consultant search behavior. You say using proprietary data from a major fund data provider, you analyze the screening activity of investment consultants who advise institutional investors with trillions of dollars in assets. And you find that these ICs, these investment consultants, frequently shortlist funds using threshold screens clustered at around base 5 or base 10 numbers, like 500 million in assets under management. You want to talk a bit about this? This seems, again, intuitive, but it just seems so inefficient.
Yes, I think this is again, there's a long line of literature in a way looking at what kind of heuristics investors or even consumers use. Yeah. Whenever we go to stores, many a time we see the prices at $1.99, $2.99. In a way, it's the left digit effect in terms of some people perceive, and many people might perceive $1.99 to be a bit closer to $1 than it's to $2. Yeah. So that's the same kind of thing. There might be this kind of heuristics, I think, which where the consumers or investors might use, and there's some research on that. What we want to look at is this investment consultants who are again major agents in this market, which many of the institutions like pension funds or other asset managers, I think, when they want to invest in particular funds, they might do an RFP, request for proposal, and then they might actually go through these investment consultants. Yeah. We wanted to see whether they also use this kind of heuristics. Again, it's not necessarily a bad thing. The way we think of it as is a consider then choose kind of strategy, because the universe of funds available is very large.
Right.
So what they might do is you don't want to look at 3,000 if the effort is costly. You might not want to download all 3,000 firms and then do due diligence on all 3,000 of them.
Right.
You might use some screens. Yeah. And to actually cut down that list, and based on that, you can actually maybe do more due diligence on those subset. So we have the data on the screens that they use. And interestingly, what we find is these investment consultants who are, again, sophisticated players, they also use thresholds at $500 million of assets under management, or $1 billion in assets under management. So those round numbers that we see.
Right.
And more interestingly, and I think in line with this, we find that once they're shortlisted, that is, think of two funds, which are maybe one is at $501 million and another one is at $499 million. Yeah. They're the same on all dimensions, except one is above the threshold. So it will make into the short list of the investors or the investment consultants. The other one doesn't make it.
It also acts as sort of an entry barrier for small firms, right? So, this is sort of perpetuating an idea that bigger funds are better, sort of. So if you don't get to that threshold, your chance of getting to that threshold is lower. It works against you, right?
Yeah, that's true. I think that's exactly in a way what we find is the one which is above the threshold, they actually have higher fund flows into them. Whereas compared to the one which is below the threshold. So the one which is larger just made it past the threshold, now attracts more funds. Right. Till again, I think it goes to the next threshold in a way. So there's definitely some value to that. So that's why I think funds would want to. And again, this is not a phenomena only in something. Again, we know from any of the schools, right? The US news, top 20, top 30 makes a difference. What comes on the first page in the top 10 lists? That's why they say proliferation of those kind of lists.
Yes.
Because anytime we say top 10, there's a value to that. So
it perpetuates the same things into the future, a bit like machine learning. So if you just look at history, you're going to perpetuate history. This is one of the issues that, as you know, artificial intelligence is going to have as well.
That's
go ahead.
very important, because I think if the model is not trained on the data, it never has seen that.
Right.
In a way, like it might not be only it's the one on which it's trained on. It might be able to give predictions close to that, but it's a interesting thing. And how can it give predictions? That how might you do the model predictions when it hasn't seen something? So that's where I think all the issues about what data it's trained on, if it will actually have any biases in the data that's going to show up in the predictions. There's a very active research, I think, going on in fairness, ethics, and this type of research in machine learning.
Yeah.
And the models are getting better, but they're always models.
Right. Yeah, so this has been great, Sudheer. Thanks so much for spending time with me, and good luck with all your research.
Yeah, thank you. I enjoyed talking to you, and I think again, I look forward to conversing with you again in the future.
Absolutely. Yeah, thanks so much.
Thank you. Have a good day.
You too.